So we're going to look at Intel and do a discounted cash flow model. First, we're going to start off with the market cap, which is 264 billion. And then the stock price of 62.26. So that means they have 4 billion shares outstanding, 4.2 billion. So we're going to estimate the future free cash flows of the company and discount that back to today's dollars, and then divide that number by the shares outstanding. That way we can find out the stock price, what we call the intrinsic value of the company, to see if it's a buy or not. And we're going to need free cash flow. Free cash flow is a great indicator of the health of a company because it's the actual cash left over after operating the business. And the good thing about free cash flow is that it can't be changed at all or manipulated like net income can. So if you have a big loss, that won't affect cash flow. It's actual cash. With the income statement, sometimes you see some funky things going on because you can depreciate assets different ways, which could make your revenue larger or smaller, your net income larger or smaller in a certain period. Over time, it all nets out, but for a particular year, sometimes you have to really dig deep to see what the true numbers are. So it's a healthy looking company, as you can tell. Intel is a large company. So the free cash flow, it ranges from 10 billion to 17 billion. Net income ranges from 10 billion to 21 billion, pretty wide range. And I would look into the 10K to see why they had such a massive jump in 2018 and 2019 net income compared to the 2 years prior. Their revenue did jump up a good amount. It went from 60 billion to 70 billion. But as you can see, from 2017 to 2018, it went up about $8 billion revenue, but net income went up 12 billion, even more. So obviously there was a lot of expenses. And that's what I said about kind of funky accounting. Like it's hard to tell the true worth of a company by looking at net income. Now, in order to discount the cash flows, we need to find out the weighted average cost of capital. And the way we do that is we have to see how much it costs for the debt and how much it costs for the equity. We'll start with the debt first. So let's see the current debt that's due within 1 year. They have 3.7 billion. And then the long-term debt that's due more than 1 year, 25 billion. That's a pretty low interest rate, 1.69%. It's one of the lowest I've seen. So they got really good terms on their debt. It's a big company, so they definitely get better terms than a startup or a smaller company. So let's find the effective tax rate because you have to discount the debt by the tax percentage. So they only pay 12% in taxes. It's pretty low, so they must have a lot of write-offs or other things going on where they can get that nice of a rate. So even though they pay 1.69% on their debt, it actually only costs them 1.48% because the interest on the debt is a deduction. So you have to deduct your taxes. Now let's see the cost of equity. That's a low beta under 1, so it's very secure. It's not volatile at all. So their CAPM, which is capital asset pricing model, that's how you get the cost of debt, is 8.62%. And the WACC, which is a blend of the cost of debt and cost of equity, is 7.91%. You may be asking, how come it's 7.91%? If you look at the average of 8.6, what is the plus, and 1.48, that's 10.09 divided by 2, that's a little, about 5%. That's 7.91%. Because we don't take the average of those two numbers. What we do is we look at the cost of debt, 1.48%, and the weight of the debt. So 10% of that capital structure is debt. So 10% of the 1.48, and then 90% of the equity. The equity is 8.62%. So we multiply 8.62 times 90, 1.48 times 10, and we come up with 7.91. 7.9, yep, almost 8%. So we figured out the future free cash flows from my model. We calculated it when we entered the free cash flow, net income, and revenue. And it does that for 4 years. Then we do terminal value, which is all the future years. And then when we discount it back to today's dollars, it's actually $332 billion, the worth of the company. And if you divide that by the number of shares outstanding, it comes out to a intrinsic value of $78.45. So Intel is trading at a 21% discount. And this is the stock prices for the past 5 years for Intel. And $78.45, so you could see it's been trading below intrinsic value. It's never even hit 75. So it's been trading at a slight discount. And it was a pretty big discount in March when everything dropped, but it's come up a little bit. Now you may be asking, why is it trading at a discount? Although it's a small discount, but why not trading at a premium like other stocks? Because maybe people don't see the value, because you have to look into the future. This model is looking to the past. So you have to look into the future. How will Intel do in the future with competition from other large companies? So that's your kind of analysis and try to figure out, which is sometimes can be a guessing game, but that's the fun part. So thanks for watching. Let me know if there's another company that you would like me to analyze, and